Bitcoin is up 6% this week on the back of a military strike. A bank in Chicago quietly failed last month. The Fed is frozen. Can't cut, can't hike, just sitting. 3 things just happened, and you probably only heard about one of them. And it might not be the one that you think. Today I want to show you why the silence around the first 2 is the whole story. I'm Oceans. This is Beyond Bitcoin. Let's dive in. We are living in the age of noise. The financial system can be failing on 3 fronts simultaneously. And if there's a loud enough distraction running in parallel, none of it makes it past your cat videos. And right now, the distraction machine is going full speed. At the time of this recording, Bitcoin is trading around $67,000, which, given what we're about to walk through, seems like it should be getting a little bit more attention than the tariff of the week or the war of the month. Today, 3 things, and these aren't 3 separate stories. They are 3 pieces of the same argument, 3 ways the system is losing the plot while everyone is picking their nose. First, a bank in Chicago called the Metropolitan Capital Bank failed last month, January 31st in 2026. First bank failure of the year. 82% of its assets were locked up in commercial real estate. Regulators shut it down on Friday, but Monday morning, it wasn't a lead story anywhere. Second, the Federal Reserve is frozen. Powell can't cut without making inflation worse, and he can't hike without making the debt worse. His term ends in May, and there's political pressure on who replaces him. Meanwhile, $10 trillion of U.S. debt needs to be rolled over this year at current interest rates. Not the rates of 2020, current rates. What are those rates at again? 3.75? What were they in 2020? 0.25? And third, while all of that was happening, Bitcoin didn't wait for anyone to notice. Strategy made its 101st consecutive weekly purchase. ETF inflows hit 458 million. And when Israel and the US struck military targets in Iran on Saturday morning, Bitcoin moved up, not down, up.
It's going up forever, Laura.
The thesis here is simple. The system is sinking like the Titanic while the band softly plays the tariff sonata. And we've been watching it long enough that it's about as old as Rose. A bank fails, fine. The Fed freezes, fine. $10 trillion rolls over at 4%, fine. Bitcoin doesn't care whether we're paying attention. It just keeps going. Never let go, Jack. Never let go. Let's start with the Metropolitan Capital Bank. January 31st, 2026, Friday afternoon. FDIC steps in, cites unsafe and unsound conditions. Says the bank had an impaired capital position. Deposits go to a bridge institution. Branch doors close. You probably didn't hear about this. I want you to sit with that for a second, because I think the silence is more telling than the failure itself.
In case you missed it, Chicago's Metropolitan Capital Bank and Trust was shut down this weekend. Regulators stepping in to pull the plug, citing unsafe and unsound conditions with an impaired capital position, aka they were broke. Now, the FDIC, the Federal Deposit Insurance Corporation, stepped in to oversee the failure, honoring deposits up to $250,000. But next time, depositors might not be so lucky because the story doesn't end there. There's an old saying that if you see one cockroach, it's never just one. Meaning that while this might be a small bank failure, this could be the signal that many more are coming.
First bank failure of 2026. Now here's what's actually in their portfolio.
The Metropolitan Capital Bank had $261 million worth of assets and $212 million worth of deposits, which sounds pretty great. But let's pause for a second, because most people, when they hear the word asset, they picture something with value, something positive, like real estate, cash, gold, silver. But for banks, assets are very different. Typically, assets are someone else's liability. This is a very important distinction, and loans are the biggest piece of these assets. So let's say you take out a mortgage from a bank. Well, that's an asset for the bank, but a liability for you. The same goes for commercial real estate loans. Business loans, treasury bonds are often also considered part of their assets, which all is great on paper, but not always in practice. The problem is that right now in the US banking system, all of these so-called assets are really massive unrealized losses, meaning banks can't sell them for what they bought them for or what they are worth on paper, making their assets completely illiquid. In this particular case, it's come out that 82% of Metropolitan Capital Bank's portfolio was in commercial real estate and private equity funding. Commercial real estate, which used to be seen as one of the safest places to invest. There will always be demand for commercial real estate, which we'll get to in a second. And while I'd like to tell you that this is an anomaly, the truth is that over 2/3, the majority of total commercial real estate loans in the United States are held by regional banks, meaning the exposure and the risk that this bank just went through is happening all over the country.
82% in commercial real estate and private equity. 82. Commercial real estate, truly one of the most pristine of failing asset classes. Empty office towers, retail space nobody needs, strip malls worth half of what they were financed at, filled with Pilates studios and nail salons. Well, one small bank in Chicago just confirmed what everyone's been ignoring. Now, $261 million is not SVB. SVB was at $209 billion. This is a rounding error by comparison. But the reason small failures matter is the same reason the cockroach metaphor exists. You never see just one. Here's what got me about this story. It wasn't the bank itself. It was the crickets after. No CNBC talking heads, no breaking news scroll, no economist panel. You had to specifically search for it to find it. Well, I didn't. My AI agent did. But I digress. An FDIC insured American bank deposits, branches, the whole thing shut down on a Friday. And the news algorithm had already moved on before the weekend was over. The normalization is the story. We've seen so many crisis signals over the past 5 years that we've stopped flinching. And that's not healthy. That's the most dangerous state you can be in, when warnings stop feeling like warnings. Quick pause here for a second. I want to talk to you about sat123.com. They offer satellite phones, solar power generators, and portable power stations. So if the grid goes down, or if the cell towers don't work, or if you want an actual plan when things get uncertain, you need to go to sat123.com. It's got you covered. And if you use the promo code SIMPLY at checkout, you'll get 15% off your entire purchase. That's sat123.com, promo code SIMPLY. Topic 2, the Fed. Richard Clarida was the Fed vice chair under Powell. He's not a Bitcoin person. He's a former central banker giving a measured assessment on a Bloomberg podcast. Keep that in mind. And what he said was remarkably honest. Take a look.
Stephanie Kelton has a theory which is very much against people like you on what modern monetary theory should look like. And part of that theory is the intrusion of politics into monetary economics. Right now, we're doing almost Volrasian tariff law, McKinley tariff law, certainly, from the 19th century. Can the political system be patient enough to get declared as medium-term success?
Well, I'm not sure. And in particular, it gets at another fundamental idea in economics, which is the idea of time consistency, that eventually people figure out that your promise now may not be delivered in the future. And so that's why, in particular, if the 20% tariffs that we're hearing about are really the beginning of a negotiation, that also adds an additional layer of uncertainty on top of just knowing what the tariff number is now. You know, Tom, we saw when I was at the Fed in 2019, that in fact, just the uncertainty about the trade policy itself was a damper to the economy. And that's a very tangible fact of life in macro. And I think we're seeing an elevated version of it now.
Intrusion of politics into monetary economics. That's a former Fed vice chair saying the tariff policy is historically unprecedented and it's compromising the central bank's ability to function. On a Bloomberg podcast, he's saying this. Here's the trap that Powell is in. Inflation is still running hot around 3% PCE. That's well above their target of 2%, I believe. So cutting rates looks like throwing gas on the fire. But the economy is slowing. Growth forecasts are coming down. Companies are pulling back on investment because nobody knows what the tariff environment looks like for the next quarter. If that continues, the Fed needs to cut to stimulate. So if you can't cut and you can't hike, you have to hold and wait. Powell said it himself at the January 28th FOMC press conference.
We don't take things off the table, but it isn't anybody's base case right now, anybody's base case, that the next move will be a rate hike. But, you know, ultimately we'll do what we think is the right thing. But that's not where people's expectations are right now.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of turmoil recently, in part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
Over time, you've seen that U.S. rates have remained they haven't moved a lot really for a while, but they haven't moved a lot because of what's been happening in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better.
The debt is not unsustainable, but the path is, Powell says. Not anybody's base case right now that the next move will be a rate hike. That's Powell speak for, we're not doing anything anytime soon. We're watching the data and hoping the tariff situation will resolve itself in the background. Now, here's why that's a real problem rather than just a boring C-SPAN clip. The United States government has roughly $34 trillion in total national debt. But again, it's sustainable debt, so it's okay. $10 trillion of that needs to be refinanced or rolled over this year. New bonds, new rates. Those new rates run around 4.1 to 4.2% on the 10-year. And if I understood what I was talking about, man, I'd be rich. But most of this debt was originally issued when rates were near zero, and in some cases, literally zero. Here's James Lavish, who actually runs the math on this in real time, I should add. Take a look.
Now you've got $10 trillion of debt that's got to be turned over annually, plus you're adding $1 to $2 trillion of that every single year, probably more. And you need more buyers of treasuries. Where are they going to come from? Well, now you've got this whole fight in Congress about basically the stablecoin legislation that they're trying to make it. They're trying to create a situation where you have stable coins that are pegged to the U.S. dollar, clearly, issued through banks, and the banks are the ones who are going to be buying these treasuries because they're using them for stable coins.
$10 trillion of debt that's got to be turned over annually. Plus, you're adding 1 or 2 trillion of that every single year, probably more. At 4% on 10 trillion, that's $400 billion a year, just in interest rates on the rollover, more than the entire defense budget. And the reason this connects to Bitcoin, the reason I'm not just doing a macro podcast, is that there's only one real lever left, one way out of a debt spiral of this magnitude at these interest rates. Can you guess what it is? Print, baby. Yes, that's right, print. Inflate the debt away. Let the dollar buy less so the nominal number becomes more manageable. Oldest trick in the monetary playbook. Works great for government and goes perfect on toast. The downside is it doesn't work for anyone holding dollars. And there's this. Powell's term ends in May. There's already public speculation about his replacement. Whether Trump wants someone to be more cooperative. A cooperative Fed, by the way, means a Fed that prints when he's asked. So that's where we are. Let's talk about the good news. I want to give a shout out to the Bitcoin way. If you've been sitting here for the last few minutes thinking, I should probably take my Bitcoin off in exchange. Yes, you should. And the Bitcoin way is the team to walk you through that. Book a free 30-minute consultation, no pitch, no pressure, just a real Bitcoin-only practitioner walking you through secure self-custody, step-by-step. Hardware wallets, running your own node, the whole setup. Go to thebitcoinway.com/beyondbitcoin and book that 30-minute consultation. It's free. Book it. Now, topic 3, the good news. While the Chicago bank failed and the Fed froze over, the debt clock was running, Bitcoin was just doing Bitcoin things. Strategy made its 101st consecutive weekly purchase every single week for almost 2 years. They have bought Bitcoin. Not we plan to buy Bitcoin, regardless of price, regardless of what the next news cycle says or serving you up. 101 weeks. In that time, a tariff war, a banking failure, a Fed that won't move, and one actual military war. Strategy bought Bitcoin through all of that. Dude is committed. Here's Saylor on CNBC a few weeks ago. Take a look.
I expect we'll be buying Bitcoin every quarter forever.
Just so we all understand, what is the price at which this story gets much more complicated for you and therefore the rest of the Bitcoin community. I think there's a sense that given how large a player you are, if the price of Bitcoin were to fall to a place and continue to stay there for 2.5 years from now, and you were forced into a selling position, that unto itself could create a cascading problem.
Andrew, if Bitcoin falls 90% for the next 4 years, we'll refinance the debt.
90%. Bitcoin's never dropped that far, right? His answer was essentially, there isn't a price that will stop buying. You can think that's reckless. You can think Saylor is overextended. But what you cannot say is that he's unclear about his conviction. Bitcoin ETFs saw 458 million in inflows the week leading into this episode. Institutional money, pension adjacent money, and illicit activity money all flowing in while the tariff story ate your attention. And then Saturday morning happened. Israel and the United States struck military targets in Iran, which from a market's perspective is the exact worst time for something geopolitical to happen. Stocks are closed, bonds are closed. The only thing that trades on a Saturday morning is crypto. Historically, when fear spikes on a weekend, Bitcoin goes down. Since it's a highly liquid asset, it's the only thing you can sell when markets are closed. So people sell it. Here's CNBC from the days after.
Even after U.S. and Israel's attack on Iran over the weekend, by noon Eastern, Bitcoin crossed the 70K threshold and was trading at $73,317. Crypto markets largely recovered after a plunge in the immediate aftermath of the attack Saturday morning. Prices jumped on Tuesday and are heading even higher Wednesday morning. Now, for the week, Bitcoin was up more than 6%, ETH by about 3.5%, and Solana by more than 2%, all outperforming broader markets.
Bitcoin crossed $73,000 for the first time in about a month, up 6% for the week on the back of a military strike. Here's what a representative of Pantera Capital on Bloomberg said about it. Take a look.
And people are starting to realize that actually Bitcoin and other digital assets have always been a safe haven asset and have always been a borderless, like sovereignless asset. And so when there's geopolitical conflict, nothing in blockchain really gets impacted. And that's why we're seeing investors come back to this story and realize that there's an interesting entry point.
So what does the move in Bitcoin and other altcoins say about the current risk appetite right now? Because on the one hand, we've seen a lot of broad risk-off moves in the market, like software stocks falling in yesterday's drawdown, but that runs counter to the moves that we're seeing in the crypto market right now, specifically Bitcoin, which would typically suggest a risk-on sentiment.
I think it really depends on the context that the assets are found in, right? I think Bitcoin and other digital assets have just been so oversold over the last few months. If we go back to just even February, we saw one of the largest sell-offs in a very sharp move after Kevin Warsh was nominated to the next Fed chair. We saw very large liquidations of on-chain assets by what people call OG Bitcoin whales or OG Ethereum whales. And so there's just a lot of selling that has already happened for the digital asset space that really we didn't see in other asset classes. Other asset classes have been doing great for the last few months.
People are starting to realize that Bitcoin has always been a safe haven asset. Yeah, they're starting to. But okay, better late than never. The 24/7 global monetary asset absorbed a Saturday morning's worth of geopolitical fear and came out 6% higher for the week. While the Bank of Chicago was cleaned out, while the Fed was holding, while $10 trillion of debt was rolling over at 4%. Bitcoin didn't need the news cycle to be favorable. It didn't need Powell's permission. It didn't even need the Fed meeting. It just kept crushing it. Real quick one before I sign off. I want to talk about ClubOrange, formerly known as the Orange Pill app. It's the premier phone app for connecting with Bitcoiners like yourself. I've been connecting with a lot of you folks on there, and honestly, it's been awesome. If you want to be around people who think through all of this, the bank stuff, the Fed freeze, the Bitcoin safe haven thesis, that conversation is happening on cluborange.org every single day. And if you want to reach out to me directly, you can go. I'm there at Oceans, OSHINS. I read every message and I respond accordingly. So here's what I want you to take away from today. Metropolitan Bank, January 31st. First bank failure of 2026. Goodbye. Federal Reserve frozen. $10 trillion rolling over at 4%. Stagflation building. Political pressure on independence. So long. Iran strikes. Bitcoin goes to $73,000. 101st strategy purchase. Bitcoin also mostly gone after Saylor buying it. Oof. 3 things that barely registered because your algo just loves to show you exactly how you can reduce your back pain. Easy. Just buy Bitcoin. I think we've built a very dangerous tolerance for bad signals. The warning lights are on. They've been there for a while, and we've just adjusted to them being on. We've decided that it's just what the dashboard looks like now. But the warnings are still warnings, and the debt is still debt. And even if it's sustainable debt, the Fed trap is still the trap. Bitcoin is the only system I know that doesn't have a snooze button. It doesn't care about the noise. It doesn't have a press conference to tell you things are fine. It has a fixed supply of 21 million, a predictable schedule, and no board of directors to call up and ask for a favor. So do yourself a favor and study Bitcoin. Not because the number goes up, but because the alternative is holding something that a frozen central bank and a $34 trillion debt load are quietly working against every single day. Thank you so much for watching this video. If you like what you see and you want to see more, make sure you hit that like button below, or you can subscribe to the Simply Bitcoin channel for more content like this. We're coming out with it every single day. Also, do not forget to hit that notification bell. You can just leave us a comment. If you want to reach out to me directly, I'm at RunDanceBitcoin on X. I'm Oceans. This is Beyond Bitcoin. Until next time.